Thanks again for everyone joining. Today we're going to go through a bit of recap on H1 and then deep dive into our views for the H2 or the rest of the year. Next slide, please. Quick agenda, like as we have some of the clients who are new to Syfe, we'll give a quick introduction, then go into recapping what happened in H1. Then, yes, our views on H2, how to position your portfolio across Hong Kong and Singapore. Next slide, please. So today we'll be done by Ritesh, who is the managing director and a very familiar face for clients in Singapore. He heads our investment and advisory team. And myself, I head the investments team in Hong Kong. So some of the Hong Kong clients may have seen me in the past. So let's start and dive directly into a bit of the introduction of Syfe. Yeah, I think most of the clients who are joining us have heard it, have been with us for a long time. But I'll give a quick intro to clients who are new or have not been with us for a long time. So Syfe is a digital investment platform. We built it with a mission to help and empower anyone, everyone to manage their wealth better. Like we offer managed portfolios, cash management, and brokerage solutions. So truly like an all-in-one platform where effectively, if you know what to do, you can use the brokerage platform to buy your Teslas and Nvidia stocks. If you have idle cash sitting in banks, you can use our cash management solutions to earn higher yield. Or if you don't have time, if you don't have any know-how, you can use our managed portfolios to build your wealth for a long term. So effectively, like a complete solution to do with anything with investments. Now we are APAC first, so like pan APAC. Next slide, please. So we launched our journey in 2019, so more than 6 years ago in Singapore. Soon after, we expanded regionally across Hong Kong and Australia with a recent acquisition in Australia, which some of the existing clients would have heard about. We have become one of the largest, if not the largest, wealth player in APAC. Across the journey, some of you know, would already know and have seen that our approach has been very product-led, bringing innovation, be it the REIT Plus portfolio very early in our journey, or the first brokerage platform in Singapore, or some of our cash solutions that we recently did. Effectively, again, with that mission in mind, with that view in mind, that how can we help all our clients in a much more holistic way, and how can we bring innovative solutions which truly makes it unique and matters really to clients. Next slide, please. So we are trusted by more than 250,000 investors just alone in Singapore. We cater to 7 to 8% of adult population. So we have grown significantly and again across Asia. The key thing for us is like we try to bring those carefully curated portfolios to the investment team's expertise, bringing those institutional grade solutions while still maintaining the highest standards of security and transparency. We know for anything to do with money, I think these things are super important. But at the same time, again, bringing those innovations, bringing those solutions which in the past might have been not accessible for normal clients or have been very expensive to invest into. So yeah, so I think this was a quick recap of Syfe. I think before we dive into the next section where we'll quickly go through what happened in H1, we had some poll questions to ask. So can we bring those questions in? again, yeah, you can scan the QR code uh, to reply. So the first question was, which asset classes are you most optimistic about in the second half of the year? And it's obviously interesting to see a lot of people still very bullish on equities. We'll again come to that and share our views in due course, but quite interesting. Can we go to the next question? Yeah, so the next question was, which of the following best reflects your current market outlook? Um, Again, from the sounds of it, a lot of people are still bullish, uh, either expecting more upside and will continue to invest more or will stay invested. And again, I mean, and as we go through today, this is quite in sync with, again, Syfe philosophies and what we believe in. Can we go to the next question? For your equity portfolio, which region are you looking to increase exposure? Okay, this one, quite interesting. A pretty balanced view across US and emerging. Okay, and emerging increasing.
Yeah. Hey, Archit, and hi, everyone. Thanks for joining in. Ritesh here as well. Very interesting to see these data points from your standpoint as well. Looks like a barbell strategy, right? Like, people want to be, having the US exposure, where there is still a lot of excitement. But at the same time, I mean, it's good to see this, very high allocation to emerging market. And, no one is interested in Europe and Japan, it seems. So very interesting. Um, all right, let's move on to the next section, Archit. Like, obviously, it's been a really roller coaster of a ride in the first half of 2025, right? What, according to you, was the biggest highlight for the first half? And, what is it that, what are the things that were the movers and shakers? And how should investors kind of like evaluate what happened and how they should be thinking about their portfolios?
Yeah, and yeah, I mean, I think a good starting point, and this is something which I think as we went through H1, a lot of our clients have been asking, and we have helped and we have right those that very volatile H1. I'll go through it quickly in that session. So maybe next slide. So yeah, so I think this gives a decent picture of like how, and this is a chart of how S&P 500 moved in H1, highlighting key market events. And I think the very first thing, if you look at the chart, is the resilience of equity markets like S&P, touching again all-time high, while dropping like very close to 20% intra H1. And of course, like a lot of things happening, starting with tariffs, starting with increase of tariffs, negotiations putting on the table, then the AI and DeepSeek moment, which pulled down tech and AI names in the first quarter. And then obviously April 2nd, where a huge amount of reciprocal tariffs came in, but then very quickly were paused. Um, then the Middle East geopolitical tensions. A lot has happened, but again, if you take a step back, the markets bounced back aggressively, and have hit all-time high. Now these are US markets, and next slide, please. If you look deeper and to answer Ritesh's question, I mean US markets did bounce back and is up like 6% by end of H1, even after having that large close to 20% intra H1 drawdown. But the key thing that I think what we have been talking about for some time, as well as like I think what market has observed and has reflected is the first or most important thing for H1 in our view is the US dollar depreciation. I think this is something probably caught off guard a lot of investors. But I think uh, people who have stayed diversified would have had tailwinds and would have got an advantage. And if you look at this again, the numbers here, European equities up 24%, but in and all these numbers are in US dollars. But if you really look deeper, like 13-14% of that is purely coming from dollar depreciation or euro appreciation. So this clearly uh, puts like a big question in mind for a lot of investors, a lot of international investors, um, non-US investors, basically, that like the bar for investing in US becomes higher if the dollar continues to depreciate. Um, so that, I think, to answer Ritesh's question, is in my view the the uh, the most important thing that H1 showed us, and potentially will continue to be one of the important thing which we should be very careful about in the second half. Next slide, please. Yeah, so I think moving on to H2, and I think it'll be super important to take this context of what happened in H1 and see how all of us can position our portfolios better, build that resilience. Next slide, please. So yeah, so I think few questions, and maybe I'll kick off and for Ritesh. So I mean, I think we've all seen like and like the Q1 GDP print of the US was negative. Um, Now the questions I think a lot of us have is, are we heading into a recession? What does it mean? What impact like tariffs would play out? And like, is market being too bullish about things or not? And of course, I think the second thing, like inflation numbers have been volatile. Would those soften? How would the Fed play? All these things will eventually have a big impact on the bond markets, and how that will really be, that whether the bond markets will provide that safety net or not. So I'll pose this question to Ritesh. Will be great to get your thoughts.
Thanks, Archit, and very well covered on the first half of the year. Really been hard on investors, especially who tried to react to these market situations, and being active. I think did not help, because if you tried to take your money out during these sell-offs and then tried to come back in, it was probably too late. So that is like definitely one part of the learning. The other part which you covered was the US dollar weakening, and to your point, if you are investing in US equities only, right? I think that is a little bit tough as we move forward, because if you're just investing in US dollar, and US dollar did give, the equity markets, S&P 500 was up 6%, but the US dollar depreciated against, say, a Sing dollar by approximately that same amount. So net, you were zero in terms of your returns from the equity markets, even though the markets did move up. And to that extent, I think the bar has moved higher. And also, there are still a lot of uncertainties, right? Like, we are still jostling with what the tariff will mean for us as we move forward. We have concerns around growth. Will there be a recession or not? Inflation might be impacted because of tariffs as well. And then what does it mean from a Fed policy standpoint, right? Like, these are the burning questions that all of us have. And these are things that we want to map out as well. So from a Syfe viewpoint, we believe that yes, the global growth is slowing, but it is not, crashing or coming crashing down. So yes, I mean, like, there is some slowness in growth that we do, anticipate as we move forward. But overall, the economy does seem resilient. On the inflation side, our view is that inflation will remain kind of like range bound to a certain extent. And yes, there are some, again, tariff related implications on the inflation side as well. But overall, we are starting back on a path to disinflation, and we'll talk more about it as well. And third and most important, like on the Fed side of things, as you see, we believe as inflation starts to cool down, we will see a Fed which is a little bit more adaptable and pro, the policy shift into, more easing cycle, right? So hopefully, with slowing growth, disinflation taking place, we will see a Fed which is much more flexible in its approach to also reduce rates earlier than what the market is anticipating. So that's like one of our key calls for the second half of the year. And if you go on to the next slide, and to your question, Archit, when you say that, okay, we had a negative GDP print in the US for the first quarter, yes, we did. But if you again unravel what is happening with the market, and this chart shows it very clearly that what ended up happening was, because there was anticipation that these tariffs are coming in April, all countries and all companies, they started front loading a lot of the imports. And when you calculate what is called as GDP or growth, the formula to it basically implies investment, government spending, but net exports, right? So if you're a net import company, then basically you see a huge amount of negative contribution from the fact that a lot of imports were front loaded into the Q1, which impacted the GDP negatively. But this is a one-time effect in a way, because once this phase goes over and tariffs are actually implemented, there is no choice but to continue. Um, but the more important part is, if you see on the blue bar, the tech-led investment story still remains very, very robust. And that's where we believe that, yes, growth is slowing. There are some cracks in the economy and all, but overall, the tech side of things is still very, very robust. We also had recently the big, beautiful bill that was passed, and which means that if you are an investor in the US market per se, if you're just looking at the US market, then from an opportunity set, the tech side of things still looks, pretty strong in terms of, how the earnings, etc., are panning out, how these investments in the AI-led, ecosystem is happening. And in fact, there is a broadening out of, that investment pool as well. So it is no longer just about the hyperscalers like your Microsoft, your Amazons of the world, or Google's, but also about, the semiconductor side of things, the entire ecosystem in the value chain of the AI story that is kind of like unfolding. And there are a lot of like opportunities that it is coming up with. Like you think about the data centers, you think about the resourcing of it in terms of like nuclear energy, etc., and all. These are opportunities that are opening up within the AI side, right? And on top of that, because of the the big bill that was passed, obviously there are certain industries that stand to benefit. So industries such as industrials and financials stand to benefit, given what has happened within the domestic side of the US economy. Also, more broadly, if you look at like other leading indicators, and top of mind for macro side of things, retail sales are still pretty robust. Unemployment rate is still at 4.1%, so very, very low. As well as like when it comes to payroll increments, etc., and all, these are still very robust, right? So it tells you that like growth is slowing down, but it is not falling off the cliff. There is some slowdown in the private sector job market in the US, but overall, things are looking still very, very stable, right? And this is kind of like, if you look at the next 2 weeks, for example, the earnings growth that you will see in the S&P 500 will be a key indicator as well. And till now, we've had kind of like mixed earnings. This week, we are kickstarting the tech earnings as well. So overall, how the tech earnings like pan out will be an important kind of like indicator as to, is the momentum still on, or is things like, starting to slow down? And on the Mag 7 side of things, these are things that we'll, continuously, watch out. But yes, I mean, like if you're looking for opportunities within the US, then in my opinion, the tech side of story still looks, robust and intact, and in fact, broadening out. And then beyond that, from a sectoral standpoint, there is industrials and financials to look at.
All right.
Archit?
Thanks, Ritesh. Yeah, so let's move to the next slide. So yeah, so Ritesh, like I think like the inflation prints recently have been softer. But at the same time, like there are some views that tariffs would start having an impact a bit later in the year,
Yeah.
and there's always a lag effect of some of these things. So what's your view around it? would inflation really soften?
Yeah, so look, I think again, if you break down inflation and the various components of inflation, yes, on the good side, the tariff-related impact is starting to show up. It is still not meaningfully showing up, as you said, like it has a deferred effect on inflation-related things. So right now, tariff-induced inflation aspect are showing up in smaller contributions to the good side of the inflation story. The other parts or the contributors to inflation, in fact, is the services side. And on that front, we are seeing that there is a continued disinflation story that is panning out. And more particularly when it comes to rents that people are paying, the shelter aspect of the inflation, these are generally cooling down. And this is where essentially we have a view that this tariff-induced inflation, yes, there might be a trickle effect and more of it is yet to come, but the reality will be that it will be a one-time effect. And the more broader effect is on the services side, where it is showing signs of coolness, and which will mean that essentially over time, the inflation aspect will remain kind of like contained to a certain extent. So right now, the latest print is 2.7%, slightly above, the target that Fed has. But I think for the Fed to be more flexible going forward, the few things that needs to happen is, number one, and why we believe like the Fed will be flexible as we move forward is also because number one, the tariff impact seems to be limited and might happen, subsequently, but it will be, kind of like a one-time effect. The job market is showing some signs of cracks, right? Like, if you again cover what I covered earlier, essentially, while we are at, 4.1% unemployment, on the private side, we are seeing, job growth slowing down a bit, right? So we are seeing some signs of cracks there. And there are some latest, sound bites that we can also hear from the Fed, governors, for example. So more recently, there has been one of the governors, Christopher Waller, who has commented with the inflation target or inflation near target and the upside risks to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate. So this is coming from a Fed governor. And essentially what it signals or tells you is within the Fed, now there is increasing consensus that we should move away from just thinking about inflation, but also look at, the growth side of things and not be reactive and not be too late to address growth related, slowness. Because that will mean that essentially, once growth actually pans out, then you take action, might be too late. So I do believe the Fed will be much more flexible as we move forward. While we don't anticipate any rate cut in the July meeting, but we definitely see rate cuts starting, from September onwards.
Yeah, thanks, Ritesh. And I think, I mean, PCE being the Fed indicator, and as you suggested, like the big part of that PCE, like close to two-thirds, is coming from services, and goods represents a smaller proportion, and where probably the tariffs might have a bigger impact is goods, and services being softening eventually is reflected in our view that things will be positive from here. Okay, great. Okay, moving on to the next one, which is our theme three, and which we touched a bit. Like the key part of H1 was that US dollar weakening, and the dollar index, after a long rally, weakened more than 10% in the first half. So the question here is like, has dollar weakening bottomed out, um, or the weakening is expected to continue? Uh, and in that case, then how should we think about H2?
Yeah, so look, I think my view is that essentially while the US dollar has started its weakening cycle, if you look at the longer trajectory of the US dollar, it still has been on an upward trend for the past decade or so. So if you look at US dollar purely from a trade weighted basis, then it still is expensive even at this point. And while I think the dollar has pared back some of the losses in the recent week or so, on a more longer trajectory in the second half, we do anticipate the dollar to continue softening, especially given that if Fed is going to pivot and start cutting rates from, say September onwards, the rate differential between US dollar and other currencies will also, continue to narrow down. And that basically means, from a, again, implication standpoint, the US dollar can continue to weaken. And that again brings us back to the question as to how should investors then invest, because like technically if you are investing again purely into the US markets and US dollar is depreciating, then the bar for you to generate returns from your US dollar investments is much high. And to that extent, it is important to have that diversification element into your portfolio allocations. And again, like if we go back to the poll as well, where most of the clients are doing this kind of like barbell approach between the US market and the emerging market, that's really the way to go, in my opinion, as well, because emerging markets, and history suggests, you can see in this chart as well, that emerging markets, they tend to outperform when the US dollar is weakening. And it benefits from these currency tailwinds and kind of like these renewed capital flows as well. So overall, if you are an equity investor and if you are heavily tilted only to the US market, this is the time for you to review that allocation and see if you can add, more elements of diversification. Uh, Number one, from a risk management standpoint, but number two, also really to capture, these outsized returns that historically has panned out from these EM markets and beyond US.
Yeah, thanks, Ritesh. Yeah, I think like historically we have seen in these environments as the rate differential narrows, this is this really helps the EM equities to perform. Um, so yeah, I think which we saw in H1, and we think it's going to continue in H2 as well. Okay, next one. So yeah, so I think again a very important one, like in H1 we saw a huge amount of volatility in US Treasury, especially with the longer term and large steepening of the US curve happening, where the longer term rates went up. Um, Now, with again coupling with the US dollar weakness, like how should investors really think about income? How should we invest, and what's the right way to invest in fixed income for H2?
Yeah, I think again, great question. And the reality is, so far on the US side, the treasury yields are more or less like kind of like anchored in that 4 to 5% range, right? While on the Singapore side, you can see that the rates have already started to come off quite a bit. You can see that in your, if you're investing into like fixed deposits, money market funds, etc., and all, you are seeing, increasingly the forward returns are lower and lower, right? So obviously, when it comes to positioning and all, if you again summarize all the previous, themes that we discussed and all, if the Fed is going to pivot and start cutting rates, my view and our view is basically that the short-term rates will start to go down, right? These rates that you're seeing here are the 10-year, rates on the US side and the Singapore side as well. But more importantly, the short-term rates will start to fall off, which is a good news for the bond market, because as interest rates fall, bond prices increase. So definitely bonds are a great place for you to park money, where you not only, if you're investing now, capturing, slightly higher yields to begin with, but as interest rates fall, then you're getting some price appreciation as well. On the longer end of the curve, which you again see on the 10-year side, it is determined much more by market forces and fiscal elements and all as well. Where I do believe that the 10-year interest rate might remain anchored to where it is at that 4.5% kind of range. And what that means is, if you are invested with a very long dated bonds, that can be not so rewarding compared to investing, say, in the middle range of maturity of bonds, right? So we advocate investing into the belly of the curve around 3 to 7 year kind of like maturity buckets, high quality bonds as well, investment grade in nature. These are the more robust part of the bond market, and we see good opportunity set for investors who can then use this to not only, as I said earlier, generate yield, but also get some capital appreciation. At the same time, again, the fact that US dollar is weakening, it has impact on your income side as well. So I'm seeing, great opportunities on the local, Singapore ecosystem as well. Singapore REITs are on an uptrend. Like over the course of the last, 1 month or so, I've seen, a huge amount of like upsurge into the REIT pricing, which is very encouraging to see. And like, REITs again are becoming much more attractive as well, because if Singapore government bond is yielding you, say 2%, and REITs are giving you 6%, the 4% extra yield is just too attractive. And also REITs have been, trading at quite a low valuation for a pretty long period of time. And the other big catalyst for REITs will be, this decreasing interest rate environment and the pivot that the Fed will, come out to be in the second half of this year. So these two things definitely, looks very, very interesting. On top of that, if you are an accredited investor, the private credit market is also very, very lucrative at this, stage, because it gives you uncorrelated returns in the high single digit to double digit, area as well. So we will go into more of these in the subsequent section in terms of how you can potentially look at a portfolio allocation standpoint and all as well. But definitely in terms of managing an income strategy, you need to make sure that number one, you are into high quality investment grade kind of like bonds. You're managing your currency risk as well, having more local exposures like Singapore REITs, Singapore banks, etc., could be helpful in that regard. And if you want to again get uncorrelated absolute returns, that's where private credit becomes an interesting area to look to.
Yeah, so I think quickly to summarize these top four themes from our perspective, I think first one, yeah, as basically the growth which is slowing, but in our view not crashing. Well, we still believe there's positive implications on tech, industrial, and financials, even as the big uh, bill gets passed. Second, like with service inflation softening, overall inflation softening, the implications will benefit EM markets and as well as Ritesh was just mentioning, the local bonds. Okay, so let's move to the next one, and which is the most important one, like how effectively then we all can position our portfolios better. Ritesh, yeah.
Awesome. Yeah. So look, I think again, just to highlight a few key, pulse checks from a Singapore economic standpoint and all as well, because yes, I mean, growth looks like slowing down on the, global front. But in Singapore, we are seeing pretty resilient growth. Like, just the latest, numbers got printed out, 4.3% year on year. That's a great, sign that our economy is holding pretty well. Inflation compared to, where inflation is in the US, again, looking very much in control. But I think the bigger thing and the bigger elephant in the room is the fact that interest rates are coming down. So if you are, a conservative investor, or if you have been enjoying the high yields so far, it is no longer going to be the case going forward. So your cash will not yield the kind of yields that you were, once accustomed to in the last 2 years. And what that means is if you are looking forward, you need to adjust to these, new developments as well. So if you go quickly onto the next slide, we have mapped out how two different kind of investors. So if you're a growth investor, this is a sample portfolio that you could think about, right? Like, how do you incorporate the views that we have just shared with you through a portfolio implementation from a Syfe standpoint, right? And on a Syfe platform, I think one of the biggest aspects and benefits that you get is we are an all-in-one platform. Like, you can invest not just in, managed strategies. You have a brokerage platform through which you can express your views, and we also have cash management. So it's a one-stop all platform. But we do advocate that, look, when you're investing for the long-term growth, then you should really take a strategy which is globally diversified and not just concentrated and having just that US market exposure. So to that extent, the core equity 100 portfolio that we have on our platform is really the base and the foundation that you should have to begin your investment journey into the equity market, right? So that should be the foundation. And then if you want to express some of the views that we just shared, so if you want to take that extra exposure to the emerging market or to this disruptive technology segments, etc., We do have thematic portfolios like the China growth portfolio. You see on the light gray or the light blue section in the satellite part, we have these two portfolios which you can add on to your core allocation. And not just that, like, people are excited about what's happening in the AI side, and people want to invest into the Magnificent Seven stocks as well. And we make it very easy through our brokerage platform because these are, available literally at one click. So instead of trying to, buy these seven stocks one by one, you can actually do it all in one go through our brokerage bundles proposition. But really, I think the idea is when you are a long-term investor, be sure that you are, starting strong and starting with a, foundation that is globally diversified. And that's where the core portfolios is, the place for you to go to and kickstart the journey and all. And also, like, when the markets are down, like what happened in April and all, these are the times where you should not be looking to withdraw money. You should be looking to add more money. Like, in fact, I doubled down when the markets was, going down during the April cycle and all. And we did like two, big webinars during that time as well to kind of like impress upon everyone that, look, these uncertainties, they come and they go. The longer term trend, if you're a long-term investor, it is very hard to time the market. So these opportunities, you either do a systematic dollar cost averaging and then map it out forward as well. Going on to the next section, quickly, how should an income investor then position their portfolios? I think, this looks very, very attractive to me in terms of what the possibilities are on the income side, given the current, ecosystem. Our income plus portfolios, which are built in partnership with PIMCO, that looks very attractive at 5 to 6% distribution yield. Again, if you compare that to the 2% yield that you're generating on the cash side, this definitely, adds up a hefty amount to that yield generation process for you. On top of that, like we covered, that you need to be high quality investment grade bonds. These are components that are already embedded into the income plus strategy. We invest into maturity of bonds between the 3 to 5 year range as well. So all of those components are already embedded. And again, from a foundational standpoint, this is the place for you to begin your investment journey when you're looking for income. And then REITs looks very attractive again, like, from a forward-looking lens, we are seeing a recovery in the REIT prices and the yields there are 6%. So these are SGD returns, by the way, right? Like, so again, you're not exposed to currency risks. On the brokerage side, we have a Singapore banks bundle. So if you are interested to take exposure to a DBS, an OCBC, a UOB, you can, do it again at one go through the banks bundle, where again, you have a combination of yield plus some growth as well. And of course, if you're a private investor or accredited investor, then you can take advantage through our private credit offering. And there, again, the elevation in yield is much more significant at more than, 10, 11%. So overall, as an investment strategy, you have your stable components, you have the appreciation components, and you have the uncorrelated high yield kind of, return components as well, which I believe is, gonna weather through the second half very, very effectively. Awesome. Archit, I'll move on quickly to you. I know we are a little short in time. So, I want to also give a chance to think through, this, all of it we have covered from a Singapore investor perspective. How should a Hong Kong investor think about, their investment strategy? Maybe a little bit color there will be very helpful.
Yeah, yeah. Yeah, so next slide, please. So yeah, I think Hong Kong, as we showed in the return numbers, like year to date has a strong rally. Like it was up 23% in H1, and it has continued that strong rally even this year. The GDP numbers of the growth have picked up in the last quarter, and I think very strong indicators. Uh, One of them is the capital markets primary, like which is the IPO. Typically, IPOs are generally a lagger in those effects. Like people starts to participate in IPOs when a bit later than the more mature secondary markets. But in H1, Hong Kong market as a whole like saw 7 times IPO inflows compared to what we saw in the H1 last year. And at the same time, the H1 numbers of inflows in Hong Kong were amongst the largest in the world. So it even surpassed the IPO issuance or inflow market in the US. So again, like super healthy from a economic perspective. The like we've seen that the Hong Kong China companies have become much more domestic than the Trump 1.0. So the impact of tariff in reality has been muted. With in addition to like monetary easing, supporting policy measures, it all shows early signs of economic improvement. One chart on the right, which I think is an important one, which investors in Hong Kong would have seen, like the HIBOR rates plummeted in early May, and and like this is an important one, which effectively, in some respect, also supports like economic development with if the borrowing cost, if the overall and housing mortgage rates are lower, it helps to boost the economy. Now, the key reason here was effectively the US dollar HKD peg. And as the US dollar continued its depreciation in that first quarter, touching the lower end of the peg, the central bank in Hong Kong had to step in to effectively buy US dollar and sell HKD to support the peg, which effectively meant increasing the liquidity of HKD and eventually causing that big drop in HKD rates. Now, I think next slide, what effectively it means for investors and similar, like I think to what Ritesh was saying, like for growth investors who have a bit of risk appetite, thinking long term. Similar strategy we could like the Syfe investors in Hong Kong can apply as well, which is a big part goes into the core portfolio, which is long term diversified, with obviously putting a bit of those tilts into either emerging markets like China or technology sector. The next slide. Now, I think for income investors in Hong Kong, and this is particularly, I think, also slightly relevant, as I was just talking about the HKD rates dramatically going down. This imposes a challenge, like I think, for local investors, like how to earn that passive income and how to continue to basically meet the expenses and keep that passive income levels high. Now, I think from our perspective, how we see about it is like slightly again, the short-term rates have gone down, but if we look at the fixed income market, which is like, and as Ritesh was saying, that the sweet spot of medium term, like 3 to 5 year, the yields are still very attractive. Like our income plus enhanced and pure are offering close to 6 to 7%. And at the same time, I think what people can benefit is from our cash management solution to counter for some short-term liquidity needs. We believe there, and one reason why we show USD here is the rate differential between HKD and USD have widened dramatically, like even for the short term, close to 3%. So while the peg continues, and we believe that the peg will continue, it's a good time for Hong Kong investors to think about US dollar, as the rate differential is significant enough to basically command a bit to take that US dollar HKD risk within that peg. So hence a bit of suggestion where those cash portfolios can help on liquidity, but at the same time do it in US dollar to have a slightly higher yield. So yeah, so given in the interest of time, I think we want to reserve decent amount of time for Q&A. So we'll pause here. I hope this helps for all of you to get a good sense of our views on H2, how and especially how to position the portfolios across Hong Kong and Singapore for the relevant investors.
So we'll open it up to the Q&A, right? So let's go and quickly check how you guys are thinking about it. Please do post your questions. Like we would like to take as many of them as possible. So please do, post your questions. All right. So there are already a lot of questions that we see here. If anyone, would like us to pick a particular question, please do upvote it so that we can, accordingly prioritize as well. Um, Otherwise, we'll just keep going from the top. Cool. Um, Maybe Archit, I start with like a couple of them, and then you continue as well. I think like the US dollar depreciation theme, seems to be the biggest theme out here, with multiple questions. The first three all focusing, in that direction. And then the first one basically asks like, with US dollar depreciating and recommendation to move towards emerging markets as per historic trends, any recommendations for which markets to look at or any Syfe portfolios? That's number one. US dollar weakening massively. Any changes in 2026? US dollar weakening, is it a good time? Oops. To hold a heavier weightage in Sing dollar in upcoming. Okay, great. So look, yes, I think in terms of the view we've already shared that we do see the US dollar continue to weaken as we move forward as well, given that the rate differentials between US dollar and other currencies, including Singapore, will narrow down, right? So that will imply a lower US dollar. Even from a policy standpoint, the US, government and the policymakers prefer a more softer dollar kind of like going forward. Um, Plus, I think, as we covered earlier, from a trade weighted basis, US dollar does still seem a bit expensive. So, and in terms of positioning, then yes, I mean, like, if you are an investor into the equity market, you would look at the emerging market. I think emerging market as well as, Asian markets per se. So within that context, we see China, India, and Korea as some of the key drivers of the Asian economy. Especially, I think in India, you're seeing a very robust secular growth trend supported by this whole economic, I mean, like demographic dividends that are being seen there. On the Chinese side, while we did see over the last few years more muted growth story panning out of China, and a lot of like subsectors getting impacted more domestically as well as due to geopolitics and trade related aspects and all. I do believe that China is moving to a new economy standpoint, and that new economy will be led by AI, will be led by your electric vehicles, etc., and the aging population and all as well. And there are a whole bunch of these new sectors that are evolving, and which presents a lot of like very interesting and exciting investment opportunities as well. So if you're thinking about like allocations, you're already seeing the Chinese market recovering, and like if you saw in the first half as well, I think it was in the double digit in terms of returns in the first half, and over the last week or so as well, that trajectory seems intact and moving in the same upward direction as well. So overall, from a US dollar standpoint, yes, these allocations is what we would suggest. And these are possible through Syfe portfolios. For example, we have a China growth portfolio, we have a few bundles. If things are not available, you can directly buy the ETFs, either through our custom portfolios or directly through our brokerage portfolios as well. In terms of heavier weightage in Sing dollar terms, look, I think, while this does present an opportunity to invest or, say, have a higher allocation to SGD denominated instruments, especially your REITs and banks. But it is also important to be, having that global diversification, because if you were invested into REITs over the last few years, you will be not happy at this stage, because that over concentration meant that like REIT prices continued on that downward trajectory for a fairly long period of time, and you got stuck. So I would say still have that global diversification through a bond based portfolio which has Sing dollar kind of like hedged aspect built into it, which is something that we do in our income portfolio. That is the way to kind of like have that solid base and then add your REIT strategies and bond strategies. I mean, sorry, the bank, etc. Elements to it. I think I covered the REITs part as well, so we'll skip that. Maybe we go to the next one. Archit, do you want to take like Fed rate cuts delayed? What does it mean for
Yeah,
bonds? In fact, we are
yeah,
calling out that we don't see, I mean, it has been delayed so far, but we have a different view going forward, right?
yeah. I think as we covered a bit about the inflation and slowing growth, I think our view is actually the Fed rate cuts should start happening soon. But I think even now, if things get slightly delayed, which we don't expect, um, the impact on bonds should be minimal. I think overall, um, like the starting yields of bonds are still very high. And bonds and the beauty of fixed income is effectively that yields that you can accumulate, that you can earn, even if it remains elevated because the Fed cuts happen sooner, you're not you're basically still earning that yield. It gives you that big cushion for any shocks to be absorbed. Um, and I think overall, again, we still are positive from a perspective that these things should not be delayed. Um, and then I think just to extend a bit, like the key part, and which is how we have constructed our income plus portfolios as well, is again diversification. Um, Diversification as well as picking up that duration of 3 to 7 year, which is best suited in our view. Um, and and with especially the US dollar depreciation, which potentially would play out further, diversifying into Asian bonds, diversifying globally, is the way to plan that, or to mitigate and to have a balance risk going forward, while still earning elevated yields. So yeah, so I think overall we are still quite positive on bonds. Um, so yeah, I think even things gets delayed a bit, which we don't expect, it should be very positive overall in the short to medium term.
Thanks, Archit. Yeah, and I think just to add on to that, basically, if you are investing into bonds at current, like, rates, etc., probably a good time to lock in, these higher yields while they last to a certain extent, right? And you also enjoy that price appreciation, which is, I think, a good opportunity in the bond segment. So kind of like getting equity-like returns with bonds, which and with half the volatility associated as well. Let's go on to the next. I think if we can go down on this question list, because we've addressed the first 5, 6 of them. So the market is all-time continue till hearsay to move away from US. What is your view? I think, like, look, yes, it is incredibly hard to fight against the momentum with which the US market continues to move up. And I mean, like, as they say, if you can't fight it, you join it, right? So to a certain extent, look, the economic data looks very, very robust, very, even at this juncture. So there is, no reason why you should not have that allocation to the US. But yes, I mean, there is signs of, growth slowdown there, which is, potentially going to reflect as we move forward to a certain extent. And that's the reason we are advocating that have the US exposure, but just, don't have only US exposure, right? So, and what that means is, like, add, elements such as, the emerging markets, such as developed, market ex-US, etc. These could act as, other elements where, potentially maybe the equity market doesn't move much, but if the US dollar continues weakening, you get returns even because of that, right? So there are reasons why you could consider, these other markets and all as well. I think some of these questions, if we can move them to answered, I think it will be easier to just think through what are the ones that we have not covered till now. I don't have enough exposure to tech. Is it still a good time to enter? So again, I think overall, look, from a growth standpoint, like, the way to look at the tech sector is there is still a lot of investments happening on the tech sector. The earnings growth within the tech sector is still very, very robust, especially like the Mag 7 stocks. If you look at the last few years, we have hit at, close to 30% earnings growth every year, right? And while that growth is starting to slow down, we are still in double digit, growth, earnings growth, even in the next cycle or the current cycle when the earnings are about to be announced in the next couple of weeks and all. So the trajectory still looks very, very intact. But I would say that if you, don't have that exposure to tech, build it more slowly, build it, through tranche-based kind of like investments rather than a one big shot, exposure at one go. So either dollar cost average into these and do it maybe through a broader index strategy, right? Like, something like a QQQ example, is a way to invest into the more growth oriented segment of the market. But instead of like, again, going all in at one go, try a dollar cost averaging strategy to get that exposure over time, because there will be more periods of volatility, as we move forward, and that will present you opportunities to even enter at lower valuations at those junctures. Um, I think we
I'll take.
addressed, the markets being complacent. I think it's mainly because the economy is still very, very resilient, and earnings growth are still very intact. So there is a reason why the market continues to move up. And unless we see, real signs of, weakness in these areas, we believe, this can continue. But yes, you need to be, again, diversified, given that there are so many of these uncertainties, and what the longer term impacts of tariffs, etc., will be. No one has mapped out, properly. Maybe Archit, you want to take a couple of questions next?
Yeah, I can take the last one. Is it too late to buy gold now? Yeah, I think gold has had a tremendous rally last year as well as year to date this year. I think our view is still positive on gold, supported by a similar weaker dollar view. And I think we've seen that strong demand from central banks, um, with even some of the banks switching their treasury holdings into gold. We feel that provides a big support for gold. But yeah, I think overall still the like high level arching principle is staying diversified. Like for example, in our core balance portfolio, we have about 10% weight to gold. Um, like yeah, so it definitely helps on that diversification angle. Uh, Helps or gets supported by that weaker dollar. So we are still overall positive on gold.
Awesome, awesome. And I think, like, let's take this question, for example, like, someone who's got an investment outlook for the next 10, 15 years. And if you have invested already, from a US dollar kind of perspective, and you're trying to avoid cashing out in SGD today because, you believe you're incurring a loss, right? Because yes, I mean, US dollar has been depreciating. Is staying invested in USD in Syfe ecosystem a solution? 100%. Look, I think at the end of the day, from a 10 to 15-year lens, usually you would believe that your capital growth will far surpass any dollar depreciation that happens in the market. In fact, like Sing dollar has been appreciating or has been in an appreciating trend over, a longer duration as well. We have what is called as the SG near band from an MAS standpoint, which is our policymaker. We, have a view that the Sing dollar is on an appreciation path against a global basket of currencies, etc. So the reality is, like, currency related, PNL will continue happening. But over a longer duration, the impact of that PNL is much more smaller compared to a very short, duration standpoint and all. So if you're investing for the next 10, 15 years, yes, you should be investing on a more global basis across different currencies, across different markets, and across different, asset classes and all as well. And especially as a growth investor, it is kind of like also futile to hedge against that currency risk just by like buying, SGD hedged, growth oriented investment. You rather have the full USD exposure, and you build that hedge by taking, these other exposures, which are, say, the emerging markets, etc., and all as well. So that is the way for you to hedge that US dollar, aspect of, depreciation that you're seeing. But overall, I believe, like, if you have the 10-year, 15-year horizon, you should really think about, what are the areas of the equity market that will give me that growth overall, because in the longer term, the FX will be a very small component, in my opinion. And still much better than if you are investing only in Singapore dollar denominated equity, because that's the alternative, right? Like, if you don't want to invest into the equity market in, US dollar term, the option is you invest into Sing dollar terms. And from a domestic economic standpoint, the number of equity options or stock options that you have here from a growth standpoint are fairly limited, right? So it is, important that you have that global allocation to capture the global growth as well. Maybe last question, Archit, you want to take the time frame one? I think that's the only one remaining, right?
Yeah, so I think very similar to the earlier question that Ritesh was answering, like from a US dollar um, overvaluation or the undervaluation or the depreciation we are seeing. Again, I think as Ritesh was saying, the most important part when we are thinking about long-term investments is the asset itself, like is the capital appreciation of the assets itself. Obviously, currency plays a decent role, and in the short term, like we've seen how it has impacted some of the markets and the outperformance in other non-US markets. But I think if we compound that thing over a longer period of time, the asset value appreciation or the capital gains will supersede the currency moves um, 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 like for a very long period of time. So like I think like in our view, slightly diversifying away from USD is a play now, but definitely I think not giving away completely, and I think that's what I think we have been suggesting, and like reducing a bit of reliance on the US dollar in the near term, increasing emerging market exposure is the way. But obviously, I think the depth in the US, the growth in the US overall is still going to be is still going to have a significant impact beyond the currency moves.
Awesome, awesome. And yeah, look, I think the currency move is a bigger play, in my opinion, on the income side. So if you're an income investor, then I guess you should be worried about, currency because you get, your dividends, your coupons, etc. If there is continuous FX movement in that, respect, then you'll be worried, right? So that's why, when it comes to income strategies, we have our portfolios, which is the income portfolios. Um, those things are areas where, we have the currency hedged option available on our platform as well. So we do take care of the currency aspect where relevant. I think two more questions came up, so maybe I'll quickly take them and wrap it up. Any comments on MAS announcement about equity injection? I think it's a huge, huge thing for the Singapore ecosystem. So the announcement here is basically MAS injecting up to $5 billion into fund managers that invest into local Singapore equities. I think it will be a huge boost to the overall, SGX kind of ecosystem where you will see much more liquidity because of, this injection. And because of the increased liquidity, you will see increasingly SGX becoming one of the kind of like hotspots in terms of where people and companies would like that, stock to trade as well, even and more importantly, from a regional standpoint and all. So there is this is a very concerted effort to make sure that the Singapore stock market continues evolving and becomes like the default place where people come to as a venue to express their views and on a global basis. So a very ambitious move in my opinion, and we are very supportive, and hopefully we will participate in programs such as this with MAS as well. Healthcare innovation portfolio returns negative. Is it worthwhile to stay invested? Look, I think the healthcare segment of the market has gone through a little bit of a challenging time over the, particularly in the first half of the year. There are some of these headwinds that you're seeing again because of the policy-related implications in that segment. I do believe if you're again having a longer term lens and if it is just a satellite portfolio that you have, there is a huge amount of innovation that is happening on the healthcare side as well, whether it comes to genomics, whether it comes to, again, AI assisted I guess like, solving of, um, um, how do you put it? Like, if you think about like AI, using AI to actually, in the actual operational, sense, those are areas that are, becoming much more prevalent, as well as, again, the kind of like DNA related analytics that are coming in. The future of healthcare definitely looks very, very exciting. So if you want to be part of that, I guess it is good for you to have some of that exposure and kind of like, stay invested. But overall, if you have overexposed yourself to the healthcare industry, then it's probably time for you to take some of that exposure out and allocate more globally in a more diversified way. Awesome. We will, wrap it with this today. If you guys have any questions, do reach out to, the advisory team. We are here to help you. I think the link to the advisory email is advisory@syfe.com. Or, if you want to connect with us directly, you see this connect with us at the bottom of the screen. There is a Calendly link, so you can schedule calls with our team and then get in touch. And if you have specific questions about your own portfolio and how you want to navigate through the market and whether your current, strategy is, robust or not, we are happy to help you and, and look forward to, making sure that you are positioned well going forward as well. Archit, all good?
Great. Yeah. Yeah. Thanks everyone for joining. And yeah, means do reach out to us if we are always available for any other further questions.
Thank you, everyone. Pleasure to be here.
Thank
Happy
you.
investing.
Bye.